we got to fail fast. I know Greg loves this one. This is his favorite. I mean, you got to fail fast in everything, right?
Scott, what's wrong with that advice?
Essentially became an excuse for founders to take any bit of friction that's in front of them and to either give up or to like hard pivot so far to the right or left that it's like in a different market or it's a completely different concept. And I believe that Eric meant it's really failing fast and pivoting in general is more about calibration within your initial idea, not floundering around left to right and essentially not ever staying in the lane long enough to find the kernels of truth and the depth that leads to success and a solution.
Welcome to the Founder's Journey podcast. Inspiration, education for founders by founders.
Hey, welcome back to the Founder's Journey podcast. Back here with my co-host, Peter Dean. Peter, it's like it's been forever since we did one of these together. You've been flying solo for the last few recordings.
I know. I was like, I missed you. I wish we could be together.
Well, we're reunited. We're reunited.
Yes, exactly.
So we're reunited today for actually a great episode. We are joined by Scot Chisholm. Scott is actually the founder of, I'm going to let him tell the story, but a founder of a company called Classy. Classy was a unicorn and was a SaaS platform that was in the nonprofit fundraising world, ultimately acquired by GoFundMe. So he's had a crazy journey. We're going to take a little unique format with this podcast today. So Scott, welcome to the show.
Thanks for having me. Glad to be here for the host reunion.
Yeah.
Love it.
Yeah. That's right. At least there's no tears and stuff in our. That's right. Yeah. Well, between my travel schedule, between my travel schedule lately and Peter's, it's been wild, but good to have you on. Real quick before we get into it, because we're gonna take a little bit different approach, and I mentioned that I love the stuff you put out on social media. I follow your stuff on LinkedIn, and you really put out some incredibly relevant content for founders that we're going to really focus on one piece of that today, which I think is particularly relevant. But real quick, if you could take 30 seconds, tell the story of Classy and also tell the story of what you're doing now.
Yeah, for sure. Well, first of all, it's great to be with you guys. I appreciate the invite coming on. Love to talk about the Classy story, but also everything management, leadership, operations. That's kind of like the core of my content online. So I appreciate the compliments there. So for folks that don't know Classy is basically a SaaS company for nonprofit fundraising. You can think of it like Shopify meets HubSpot meets Salesforce for nonprofits. And we got into it sort of around the 2011 timeframe when crowdfunding was really taking off, consumer crowdfunding, GoFundMe, Kickstarter, Indiegogo. And we basically built the earliest version of Classy was essentially a white labeled point solution, B2B though, for nonprofits to get into the crowdfunding space. So it was their brand forward. You would never know that the nonprofit was using Classy necessarily. We basically provided all the infrastructure behind the scenes. And then we built the suite out to be much more comprehensive. There's a full-on event platform now embedded in there. There's direct giving, there's recurring giving, there's international giving, there's more CRM functionality, et cetera, et cetera. So it's a whole basically platform for nonprofits to have an online identity and be able to really raise money from anyone online these days. Initially, it was really targeted at millennials, which feels old now, but young people kind of getting into giving online because everything was checks and cash. When we started Classy, 1% of giving was online. And now you'd think it's like 30-40% or so. It's actually only like 12% still, which is really crazy. So it's lagging other industries. The nonprofit space tends to be a little bit antiquated that way. Not necessarily because the leaders of nonprofits are any less innovative, anything like that. It's just the technology cycle and the companies that compete in the space. It just tends to be way behind the curve. So in the most macro sense, we felt like we were bringing great technology that existed in the for-profit space to the nonprofit sector. And that really was kind of the thesis behind the whole thing. You said 30 seconds, so I'll wrap up here. But it was a wild, like you said, it was an ups and down and all around journey. I mean, it was truly, we went through the ringer many a times. I'm sure we'll touch on it in a little bit. But it ended up very positive. We sold the company to GoFundMe, I think in 2022, around there. So I transitioned from CEO. I had a very brief stint as chairman of the board, and now I'm just an advisor to the company. So that's been a really interesting but positive experience, very different from someone that's in it, in the weeds, to now be sort of on the outside. But I'm very proud of the team at GoFundMe and especially Classy for just, continuing to build it into a behemoth of a SaaS company, and not getting too bloated along the way, not ending up in manager mode, as Brian Chesky would say. The company's actually running quite efficiently and doing really well. And from everything I can tell, the product and sort of the customer experience just keeps getting better. So I'm super proud of it. Both companies have raised over $30 billion combined for individual and nonprofit causes. GoFundMe is larger than Classy, but Classy is a significant portion of that. So it's a really cool story overall.
So there's one piece of the story before we get into the advice part of this, which we're going to spend the lion's share of this podcast on. There's one piece of the story I think is particularly interesting, and it's something that I think you and I have in common. You sold was it a majority interest along the way to a large private equity firm? But talk about that experience, because you've written about it online. You had this successful outcome, but this was not a straight line. I mean, you almost got fired along the way, I think, right? Can you talk about that experience a little bit?
Yeah. So, I mean, one of the issues was that we actually sold a minority stake in the company to a private equity firm that was used to having the majority. And that was actually one of the root causes of the blow up. But it was our Series C financing. We had several term sheets from VCs that you would know. We ended up taking one. We chased valuation, basically, that had the best valuation. And it was from a private equity firm that was kind of swimming downstream. Like we were at scale, but we weren't huge. So they were kind of swimming downstream. We were kind of, maybe reaching a little bit for that type of investor. So it was always a little bit of an odd fit, but they had domain experience. They had invested in the space prior, and they were in San Diego. So for us, it was like those combination of factors really were attractive to us. Oh, someone down the street, someone from San Diego, this can be a San Diego story. And the valuation, again, was really solid. But, what that did was paint or create, an expectation where everything needed to be perfect afterwards, because they had stretched on valuation, they had stretched on other terms, and they also were private equity minded. They weren't venture minded. And private equity minded is all about not losing money and basically not taking large risks for the most part. I mean, there's other ones that do. Venture is more about like, let's take larger risks, and we know that some of our portfolio companies going to fail because the couple that are really successful are going to return the money and more. Private equity is basically sort of like Warren Buffett, where it's like Berkshire Hathaway model, which is we don't want any losers in our portfolio. We don't care if they're necessarily massive drums, but we want them all to make money. And so that was kind of a different cultural ingredient, if you will, at the board level, and it's sort of that conservatism seeped into the overall culture of the company. And all of a sudden we started focusing, I call it short-term syndrome. We started focusing on the monthly and quarterly results more than any other thing in the company, at the expense of the founding principles and what made us special in the first place, at the expense of the long-term roadmap, the vision, those types of things. And those conversations sort of just got swept to the side. So you can see the picture I'm painting here, where it's like all of a sudden we were this just energetic, long-term, really, I think, performance-driven, big thinking culture. And it just turned into sort of this like incrementalism, death by 1,000 cuts, incrementalism culture coming from that investor that had a ton of influence. Where it really blew up is, we weren't hitting the numbers that they wanted us to. It was all about basically us starting to work with bigger customers, enterprise customers. And the transition didn't happen to their liking and fast enough. It actually did happen later, by the way. And it's one of our most successful areas of the business. So good things take time, right? But it wasn't on their timeline. And so, yes, they tried to fire me. They tried to push out management. They basically blocked new capital coming into the company. They blocked options going to any employees. They did anything they could do to basically bleed us out. And what happened in the culture there, it got even worse, right? Like it was almost like we had a sickness. We couldn't explain it all to the employees. We had a really transparent culture, but this was one thing that it would have freaked them out too much. Right. It basically would have been detrimental. So we had to hold back some of the conflict and just deal with it ourselves at the board level. But at the end of the day, every employee down to the lowest ranking person knew that something was wrong. They knew that the company was sick, the culture had changed.
Yeah, you can't
and
hide everything.
Really hurt us. Yeah, it really hurt us. But we were able to rally enough money to buy these guys out. And we're talking tens of millions of dollars. I mean, still to this day, people say, Scott, like, I haven't heard of anyone buying out their Series C investor. Like, that usually doesn't go well when you stand up and fight versus just sort of sitting down and letting them do the things, like bullying you around basically to get control. We ended up, it was a hellish almost 2 years. And it came down to the wire where we had raised the money. They had agreed in principle to terms. And by the way, the leverage we had was that there was some gray area around them breaching fiduciary duty. So they were on the board. They had to basically act in the best interest of shareholders, not just themselves. And there were many instances where that was definitely not the case. And so we used that as leverage to basically force them to agree to a buyout that was, satisfactory for everyone. But the last day, we think this is a done deal. We get a call from their lawyer and they say, you guys missed some arbitrary deadline to get us some information or whatever, deal's off. And we were like, oh my God, like, are you fucking kidding me? I called my wife, Carrie, and I was like, I think it's over. I think we're done. I'm done. After all that.
Yeah.
I think it's literally like the 10 years of my life. It's like, we're penniless and it's done. And I had tears in my eyes. They got back to us a couple hours later and said, okay, we'll let it pass, but you need to pay us $50,000 more in legal fees. Like, this is the type of people that they really are. Like, that they were just grinding us.
They're like grinding you.
Oh yeah, it was so bad. And now I've heard war stories like this all across the startup space. I was more public. It's like the name that I won't mention, like Voldemort in Harry Potter.
Right.
But like I don't name the name because I don't want to be super disrespectful. If you look it up, you can figure it out.
Of course.
Yeah.
But like, at the end of the day, it's not just about this particular firm. It's about firms that treat startups and founders like this. And I think that's really the topic. It's like, you got to know what you're getting into. There was certainly fault on my side. You got to go in eyes wide open to these things. And you have to understand the difference between private equity and venture, but even within the venture space, or even just within the private equity, there's good actors and bad actors, and you got to vet. And you have to
not everyone acts like that on both sides. Yeah.
Yeah. And you got to understand that, like, you got to interview the person that you're about to take money from a values perspective, just as much as anything else. Sure, they have money. Sure, they say it's the partner, not the firm, all that stuff. But the firm has values, and the values are reflected through the partner. If those values don't align with the company's values, then you're basically screwed from day one. And that's kind of what happened. It was really a values clash at the end of the day. All this other stuff was just sort of downstream effect of that value misalignment from day one.
What you said, Scott, is really important, right? You mentioned before, you were chasing valuation, and it's a really easy thing for most startups to, for most early stage companies to do. You start getting into, look, there's a lot of chest thumping that, can occur, and it's totally natural. And, it's not a criticism or a judgment. It's just, I've done it too, right? But understanding those values and really doing your own diligence on whether it's a Series C private equity, venture or private equity later or whatever, really understanding if you're aligned on strategy is just critical, and really understand, like, what are those shared values? And there are some firms, what you mentioned is pretty egregious, right? You start blocking options, you start trying to bleed the company dry, but it's not always kind of that bad. But if you don't have that share alignment and values, and these things just can go so badly. And you said it, right? 10 years of your life. And I've had those moments as well, right? Where it's, oh my God, like everything I've been trying to build and got that close. And it's like, you're dealing with those kind of issues. That alignment of values is so critical.
So important. And we took money, a Series D, later from, I will say the name of this firm, Norwest Venture Partners, and man, was it night and day. Just how they acted from day one, it was like, duh, man, if I had just known some of this stuff, or acted, had the same type of relationship pre-deal, pre-term sheet with this firm, who really was slow. They were methodical. They built the relationship. They asked the questions about us, about the value stuff, and really aligning on a go-forward plan, things like that. Couldn't speak more highly of those guys. But generally speaking, I think the lesson to all founders, and I'm still I still try to practice this now, is just, regardless if it's an investor partner or any partner, you have to have alignment on values, and you have to have alignment on
Sure.
what the expectations are. Sounds so simple, but so many people rush into things because they're excited about it, whether it's valuation or some other thing. They're like, yeah, we'll worry about that after, like, month from now, Scott, we'll figure that one out. No, like, that's not, you really got to take the time. That extra couple days even is worth it.
Especially with the valuation, that it's like, oh, this is our best deal. And it's hard not to take it. It's hard to say, well, we're going to take this for less because they align on values. How do you tell your current investors that, whoever they are?
I would even take it down one level deeper, Scott, and not only understand and really, just really truly understand the firm and the shared values, but the partner. And this is experience that I've had, right? Where really understanding who's on the deal side, is the person that you're negotiating with going to actually be the person that's going to own this relationship on the part of the firm. You get that kind of bait and switch that comes on, and you start to get alignment with the deal partner, but all of a sudden that shifts, and it's like it's like you're dealing with a whole new firm. So really understand, who is it that you're actually who's attending the board meetings? Who are you talking to with your monthly update calls? Who's your main everyday contact? And that's, in my experience, that's where really that can make or break the relationship a lot.
Couldn't agree more.
And this goes to experience. You only get these things with experience, right? And along the way, with any startup, you get good advice and bad advice. And we told Scott when he came on today that, I think among Scott's posts, my favorite recently, I think it's probably a few months ago, that you put up, Scott, was the worst advice you've ever seen. And Peter and I, before you came on, were joking, we were saying, like, what's the worst advice you've ever gotten? Because there's so much of it that founders get. So we thought we'd take a different approach. So Peter is going to play the terrible consultant, board member, investor, like the one we've all had, right? That just spews the bullshit. And you and I can, and all three of us will have a conversation about that. So Peter, you're the bullshit spewing consultant. So hit us, Peter.
This is what we've all heard.
Hit us with the best advice.
This is one.
Yeah.
I don't think anyone on this call has not heard this maybe less than 10 times. All right. We should really be failing fast, shouldn't we? Like, we got to fail fast. I know Greg loves this one. This is his favorite. You got to fail fast in everything, right?
All right. So Scott, what's wrong with that advice?
Well, I think early on it had the best of intents. Fail fast came from the Lean Startup book by Eric Ries.
Yeah.
And, he brought basically, sort of like operational Lean Six Sigma sort of principles to the startup building process. And so basically failing fast just means iterating fast and finding, what works and what doesn't, getting to that solution quicker. So you got to start with that and be intellectually honest. But essentially the definition was warped over time and essentially became an excuse for founders to take any bit of friction that's in front of them and to either give up or to like hard pivot so far to the right or left that it's like in a different market or it's a completely different concept. And I believe that Eric meant it's really failing fast and pivoting in general is more about calibration within your initial idea, not floundering around left to right and essentially not ever staying in the lane long enough to find the kernels of truth and the depth that leads to success and a solution. So what you found later on in the next generation of entrepreneurs, they read this book and be like, oh shit, this isn't working. Like, 5 people didn't convert on my landing page. That means my idea sucks. So they would completely do a different idea, or they'd be like, we're out. Right. And they would say, yeah, we raised a couple $1 million, but sorry guys, we failed fast. The concept's over. So that's why I hate it. I think it brought easiness to the entrepreneurial, group and a lot of entrepreneurs.
And how long, Scott? How long did it take you to build Classy, start to finish?
Oh, I mean, because we had a couple of years prior to even becoming a SaaS company, so probably 15 years. It's like approaching 20 years,
Mm-hmm.
in the next couple of
Right.
years. I mean, it's a long time.
Greg, how long did it take? How long did it take Outmatch?
14 years, right?
Yeah.
Yeah.
Peter, you too, like Render Tribe.
Yeah.
I mean, same thing. You've been at it
15 years.
for 15 years, right? So,
Yeah.
I mean, this is the thing, because I agree with you. Like, there is in all of these pieces of bad advice that we go through, like, there's a kernel of truth, but
Mhm.
it has become this really bastardized thing to say, hey, if you can't figure it out in your first year or whatever, go on, just go start another business. When you talk to like founders, you screw up so much. And it really, I've always taken that to mean, I think when Eric wrote that, it was about optimizing, right?
Yeah.
It was about experimenting and optimizing, not just throwing the whole shit out the window, right? And saying like,
Like,
we're on to something else.
yeah, no, it's so frustrating as a mentor to startups to see them like not really have a business because they're switching and they're
Right.
moving around. They're like, what do you have a problem you're trying to solve? What is it? Why are you doing this? Why?
Right.
Like the why is the most important thing. Is that rooted in anything or just trying to find a business out of like floundering around with like something that, like you said, Scott, like, oh, we don't have enough conversions. I'm like, well, there's reasons. Go find out what the reasons are.
Right.
Like, instead of saying, well,
Right.
it doesn't work, right? I don't know. It's
All right, Peter,
frustrating.
give us more give us more of your best advice.
This is one of my best
We're
ones.
paying you a lot of money for your advice on this podcast, by the way. So we want your best.
You should never do business with your friends ever.
Oh, this is an interesting one. So Scott, what do you think about that?
I don't know who came up with this early on or why they did. I think that most people are scared off by working with friends or family because of this sort of, adage. For me, I had the complete opposite experience. I built Classy with basically 5 roommates at the time, and they stayed for years. I mean, it's not like, we all were at each other's throats and it blew up after, year 2 or something. Somehow I got named the CEO, that worked out decently well, but I always question like why, I think it was just because I drove to the lawyer's office and got the paperwork. But we were all sort of like united.
Hey,
And
there's good advice.
That's right.
yeah, so everyone kind of fell in their lane and they did their thing and they led their function and they were there for years and years and years. And the hard part about working with friends is that you care about those people. But I would argue that if you're in a company that you're working with strangers at first, but they become friends in a way, right? Like that's a
Right.
very hard line.
100%.
So it's not black and white like that. Like, so,
No.
but
Yeah.
when you work with
No,
friends and
it
family,
really
you
isn't.
start off with a level of trust that doesn't exist with a stranger. And I think that's really valuable because when you end up, hitting a speed bump or a major bump in the road, you have sort of a resilience and you have some sort of connection that's going to help you withstand, that turbulence. Whereas a stranger might be like, fuck it, I'm out. You know what I mean? Like
Right.
I didn't sign up for this. So, I don't think either one, it's not like I'm saying, yes, always go into business with friends and family. I'm just saying that it's not necessarily a bad thing. You shouldn't run
Right.
away from that. In fact, I have my next business with my wife now. So, I think there's a lot of value in it.
I remember from the very early days of my last company where, not everybody made it through the entire thing. People checked out a different that was fine and cool. But man, I remember hiring people from the outside and there were days where like, we'd bring in, and this is going to be one of the pieces of advice. Like we brought in the hired
We're going
gun,
to talk about that one.
right? Like we brought in the person to like, hey, this is the person that's really going to shape up our sales or whatever. These people would come in and out and like, they didn't see traction. They were out the door. Like they had no relationship with us. It'll be me and the founders, me and that like core little pod of people sitting there saying, well, I don't know, but they weren't leaving, right? They were there. And, there's something that kind of camaraderie about like, we're just all going to get in the bunker together. That it's just an enormously powerful thing. It's something you have to have at that really early stage.
Yeah.
Totally.
Yeah. I would definitely say that. I mean, my first company, I started with a friend and I exited because it wasn't going where I wanted it to go. But we're still friends today. I mean, we treated it. I mean, it was a situation that could have been bad. It could have been a situation where I wasn't happy at the time, but we just talked it through, and he's still one of my good friends today. And it's like, you have to just deal with those situations as an adult and respect the person, know what the business is. It's a business, like, and still be a good person to them, And what you get is someone that's going to treat you like that. If they're really a friend, and then in the bunkers with you, like you said, they're going to treat you like that. They're going to give you grace, and where maybe someone else won't,
Right.
if you just find a not saying this is bad to go find a technical founder and then
Sure.
trying to, be aligned with someone that you become friends with. And a lot of my friends today are people that I've worked with over the years, like
Totally.
to your point. But yeah, it's amazing. So that was great. I have some other good advice for you guys. I think one of the things that you really should be focusing on, and this has been told to me recently, you got to find a bigger market. You're just too niche, like way too niche for what you're doing.
Scott, why is that
classic.
bad? Because intuitively,
classic,
right? It doesn't sound like bad advice.
Yeah.
No, it doesn't.
It's typical to run into sort of like second-rate VCs that use this all the time. And, and founders even fall into this trap too. If I can just claim 1% of this massive market, I'll be a wild success. And what they're not realizing is even to get 1% of the larger market, it's like, you're going to be unbelievably diluted. It's going to be so hard to get attention. You're going to raise so much money to do that. Whereas I look at markets like layers of the onion. So, you start at the core, like an archery target. You start at the core and then you work your way out. So I like to say, crush a smaller market and then enter the next, like grow into the bigger market. So you can obviously see in the horizon, there's a bigger market there, and you should be able to explain that to investors. But you say, I'm just obsessed with this little thing right here. And if we get this little thing right here, right, then it opens the door to the next ring and the next ring and the next ring. But you're not building for the outer rings in day one. You're going to dilute yourself and you're going to waste tons of money. Build for the center and then add just that 10%, additional features or whatever it is, depending on your industry, for the next ring, and then another 10%. And you methodically go that way. By the time you're at the fifth ring, people didn't even know who you they didn't even see you coming. You know what I mean? You're everywhere.
Right.
And I think that's just a smarter strategy.
Yeah. I couldn't agree with more. I run into these entrepreneurs that tell me the big market, and they're like, we just need 1% of this. And the thing they're always missing is what you said in this post. Do you know how much money it's going to take to even get a fraction of 1% in here? Like, there's no way you're going to win that battle. They're too freaking big. They dominate. There's no way you're going to beat them at their own game. Go beat them in a game they're not playing.
Right.
And then you can slowly work into, they're not going to see you coming. And all of a sudden, whoa, they're probably going to buy you. They're going to be like, whoa, you have an exit now. Because you just proved something they could never do themselves. Right?
The advice that I, have given to founders in our portfolio a lot is go find me the market so small that the customers in that market truly believe you have custom built something for them. Like, go find me that market. Go find me a market of 500 companies, 50 companies that say, holy crap, like this thing, Classy, was built, or Outmatch was built, or RenderTrap was built just for me. I didn't even know something like this existed. Then, start to expand out, because that's that 1% logic that, but you said it, like second-rate VCs, you hear this all the time, right? Or you hear analysts in VC firms, well, how big is the market? Oh, is the TAM big enough? And like all these things, there's truth. You need to know what does the full market potential go to. But if you actually try to approach that from a go-to-market, operationalize that thinking, you're just going to run out of cash.
Yeah, people used to say Classy's market was tiny. People used to say, prominent VCs used to say that Airbnb's market was basically non-existent, and the list goes on and on and on and on. You can't size something that you can't see,
Right. Well, especially when you're doing anything innovative too, right? It's not obvious a lot of times what that end market is. Like, Airbnb is a great example. Like, how would you have even sized that? Like, what is the market? If you're thinking about it in the terms of, what's the market size of people who are going to rent other people's houses? Like, how do you even size that market? Right? I mean, you just got some random dudes that will go crash on people's couches. That's your market? No, right? It's just a totally different approach. What else you got for us, Peter?
I'm concerned, Greg. I think your team's great, but you need to build out some more experienced executives on your team now. You definitely need more experience. Can you bring in for us like a home run hitter on the sales team?
I have a great story about this. Go ahead, Scott.
Yeah, this actually touches the whole like founder mode, manager mode thing with the Brian Chesky sort of brought up and Paul Graham institutionalized recently. That sort of conventional wisdom is, hire great executives and get out of their way as a founder. This particular piece of bad advice is just saying you have a gap, add an executive. And there's not necessarily anything wrong with that. But I would say that executives are the riskiest and most expensive hires that you can basically have. So you really need to be bought into that. And you need to take your time and be really meticulous with that selection process, because I've had many executives blow up in my face that I had to fire in a pretty short amount of time after they started. And there's nothing more harmful to the company than bringing in a gray hair and it not working out. So you really need to be careful there and not rush into it. If you don't have technical expertise or whatever, and you have a gap, well, then you needed a technical co-founder. You don't need someone that worked at Microsoft for 20 years. You need someone that's scrappy and knows how to do early stage startups. So there's also that misalignment there where the gray-haired executive's experience comes from matters quite a bit based on your stage. And then when you get them in the door, even if they're good, you can't just hand the baton off to them and assume they've got the whole function covered and they're going to meet all of your expectations and your dreams. And you can just kind of chill, elevate above them, maybe sip margaritas on the beach or something while they take care of your company. Like, that's never going to end well. That's what Chesky and later Paul Graham calls manager mode, which is essentially, it's not to say management sucks or managers are bad. It's to say, founders, wake up. Don't just take the advice of putting executives into these leadership roles and then absolving yourself of all responsibility or assuming they're going to get the quality standard right that made the company special in the first place.
What is wrong with the Microsoft for a startup? The Microsoft executive for a startup? This is the shiny object thing that people step in.
Yeah. So that example is basically saying, hey, we're a small startup and we need technical expertise. Maybe our co-founder is technical, but we need someone to run the engineering group or something. And that's what the board's saying to you. So you kind of agree. You're like, okay, we need to bring in, we don't have enough engineering talent here. It's a software company. Duh. We need some engineering leadership. Okay. Then they go out and they start looking for who to hire. Where do they come from? And the person that works at Microsoft might seem attractive from a resume perspective. They've done lots of things, but that doesn't mean, since they're working at a bazillion-dollar company, that they can get down to your altitude, which is basically early stage startup in the weeds, and be effective. So the size of the company and the type of experience and the team that they've led in the past matters quite a bit. So that person from Microsoft could be amazing for a bigger company, come into your company and actually suck. So this actually brings up another sort of thing I've written about, which is that an A+ player in another company could end up being a C- player, an F player at your company. And one of the factors that influences that is just the size of the company, the culture of that company, how they do technology, and their ability to move fast and make quick decisions. All of those things matter because of where they came from. It's not to say that person's a terrible leader. It just doesn't make sense for your particular stage in your startup.
So really early stage, there were like maybe 10 people at my previous company. We brought in a really, really, really high level. He was a CRO at a publicly traded company because we needed sales help. And this came in, somebody's affiliated with our business. One of our investors had a contact with him, and he decided he wanted to leave the corporate world and go in the startup world. But I think, like a lot of times, what you get with this is he had absolutely no idea what that meant. And the experience that I had is he damn near killed the company. Not, and I say that not to say it was all his fault or anything like that, but the learning from, and he's actually a really good guy, but the learning from it was we were not in any position to be able to support somebody like that. And I think that's the stage dependency, right? Like we could not give somebody like that what they needed to succeed. So we took a very clear A player and we stuck him and we made him an F player because we couldn't give him anything that he needed to actually go do the job we needed him to do. And I think that's that stage dependency where that, like Peter said, that shiny object syndrome, right? Of hey, we're hiring a guy and, they're coming in from Google or they're coming in from,
they're amazing.
Yeah. Right. It means nothing. I mean, it means nothing. Show me the scrappy startup player who's been involved in, a few of these things, has maybe had a success along the way, has had a bunch of failures along the way. And that's the person you want at that really early stage.
Greg's example is a good example because if you hire someone at that level of a big company, they're really not selling that much anymore.
No.
They're administering sales across a huge force. And if you're 10 people, the CEO selling, everyone's selling that possibly can be. And that person's job, if they have sales next to their name, is 100% hunting. And I mean, how is that not the job? Like,
I remember this guy comes in again. If anybody knows who I'm talking about, it none of this is meant to speak ill of him, but this was what you do in large companies.
Really good person.
But I remember he came in and like the first 4 weeks on the job, he spent trying to redo all of our stages in our opportunity stages. We weren't even $1 million in ARR. And it's like, there were like 9 different stages of opportunities in Salesforce. So it's like, dude, there's nothing even in Salesforce. Right? Like we don't have any opportunity.
We got to put something in there.
Right? We need to sell something fast, right? It's, it's wild. All right, Peter, we got one more piece of great advice. Scott and I are really struggling in our business here. So we need one more piece of great advice to try to help get us going.
Well,
here.
I think you can never raise enough capital. Like, you guys got to keep raising. Just keep raising.
just raise as much. Just stack it as high as you can get the chips, man.
Yeah, just get as much as possible.
Scott, what's wrong with that?
It's a very self-serving statement, typically said by VCs, private equity firms, whatever, because they want to deploy more capital, and that makes sense. They want to own a meaningful stake, and that's all good. And for the founder, I think that bootstrapping a business, at least for a while, breeds the best habits. It forces discipline. It forces you to operate within constraints. You can't just buy anything. And I think that in Classy, we did that for the first probably 5 years. And then we ended up going on to raise a good amount of money, actually $200 million. So, but when people see that headline, they're like, oh my goodness, did you raise that on day one? And it's like, no, not at all. Actually, people were willing to invest in us at those levels because we had proven traction, and traction's every entrepreneur's best friend. But in the early days, staying tight and lean, it really drives focus and discipline. And that's something that is hard to reverse if you start gluttonous. Like you start with discipline, you start with focus. That tends to sort of be a central piece of the culture in the philosophy of the operators for a long time. If you start gluttonous, it's very difficult to go, oh, now we're all disciplined and lean. It's not something that works in reverse very well. So I think it's a cute way of basically saying, like, do the real work first with less money, prove that you have traction, and then raise large amounts of money later. And don't let anyone push you around and say, oh, all this money is the solution to your problems. Like, that's never going to be the case. It's really the answer is with the customer, and you don't need 10, 20, $100 million to go figure out the problem that the customer is having or the solution for that customer.
Yep. I think, the advice I try to give all the time is like bootstrap it until it's truly scalable and predictable, until you really know if you put X, Y, and Z in the top, 1, 2, 3 is going to come out the bottom. And until then, spend nothing, right? Once you Once you get to that point and it's truly scalable and predictable, you can start to spend. Let me ask you a question though, Scott, because it's funny. I've got a portfolio company right now, and I hope I'm not going to say his name, but I hope he's listening to this, because he and I talk about this all the time. He's on the opposite side. And this I absolutely love this guy. His business is phenomenal. Is there but the struggle that the conversations that we've had, not a struggle, this is definitely in the first world good problem to have, is now that he actually has gotten it scalable and predictable, he's still afraid to spend. What do you tell a founder at that point? Like, what is the right amount of gas to start to apply when they become so fixated on bootstrapping and like we've been living on nothing for so long? I don't even know how to break that cycle.
I've seen that too, and that's actually that's pretty tough to break, actually.
It is.
But I think it comes down to just looking at spending money as investments. And those types of folks want to know that if I'm spending money on X, I'm going to get Y in return. And that's actually a pretty healthy thing. Mm-hmm. So look, you take a risk and you spend on X and you don't get Y, then maybe you slow down, maybe you recalibrate and you take a pause, right? Like you can do it in sort of a really methodical, pretty low risk way versus just dumping like you're not going to just dump money and double your sales team tomorrow or something like that. You don't need to, right? Like you can be methodical, but just know that, not spending the money that you have to push into a market can be just as irresponsible as spending it recklessly. Like there is a middle ground there. I would say err on the side of caution and conservatism in terms of your frugality, but definitely don't just hoard money and just keep your bank account high. That doesn't do anything. That's not actually adding value to your customer or your shareholders. So you do want to try to push in, but just do it methodically and look at the unit economics. And if those things start to, sort of, get shitty, if you will, then take a time out. You can always take a time out. You don't have to keep pushing when you see bad results. So that's what I would say.
Yeah, I think it's great advice, right? Do it in a controlled way, right? If you've got the cash pile behind you, do it in a controlled way. You don't have to take $1 million. Take $100,000. Try something, right? Apply a little pressure. Maybe take $250 if you've got the cash, right? Hire 1 or 2 people. Don't go hire 10. Like just a little application of pressure to test that scalability that you're, those sort of good indicators that you're seeing. Keep testing it a little, like pressure test it a little bit more and a little bit more. And I think, it in a controlled way, right? It doesn't, as an experiment.
It actually brings us back to the earliest comments that we were making around Eric Ries, which is basically experimentation in the early days. These are just experiments at scale. So,
that's right.
Yeah, you probably have a formula that's working. You want to invest in that formula, but you're trying to figure out the next formula and the next formula, the next variables of that formula to add to it, right? So these would just be dimensions of growth or multi-channel or new products. So you want to be testing these different things, not just throwing shit against a wall and seeing what sticks. You're going to have enough information where you're going to be making very intelligent, smart guesses here. Like these are informed hypotheses. Yeah. And so you can make that $100,000 bet. You put a person on that, see what happens in a year, and then go from there. You don't have to bet the farm on that direction unless you feel really truly have strong conviction.
Yep.
Yeah, and I think you made a point before that ladders to this one. Hiring 4 or 5 more people, and when you have 2, like that could be a strain on you. Like you have to be careful. Like, oh, we're gonna just throw $1 million. We're gonna add 6 salespeople. We have 1. Like you could fail miserably on all 6 of those people because you haven't learned as an organization to function that way or to build that team, and building that fast can hurt you. I'm just speaking from my own experience.
Yeah.
Learning from growing too fast, it hurts too sometimes.
Yeah, you have to have that foundation and you have to have the formula. And if you raise money before you have the foundation or formula set, then you have to actually try extra hard to be disciplined until those things come into fruition. I was assuming your case was the person has the formula and has a decent, strong foundation. So then it's about investing in the formula that works and finding other variables to add to that formula that make the business model more durable and diverse.
Yep.
Right.
Yep.
Yeah. That's awesome.
Well, we could, Scott, we could do this all day with Peter's bad advice to us, and but this is really fun. And And I know you and I have been talking about getting on the show for a while. I'm really glad that we were able to make it happen. I'm a big fan. I would encourage, if you're listening to this, follow Scott on LinkedIn. I'm sure you're on other social channels. So Scott, if somebody wants to learn more about what you're doing today, how they can start to participate and actually work with you, what's the best way to reach you? How do they find out about what you're up to today?
Yeah, I'm pretty active on all the channels. LinkedIn's a good one, but you can just visit scotchisholm.com. It's Scott with 1 T, so remember that part. And you can subscribe to the newsletter. I put out content pretty much weekly, deep sort of topics, operations, leadership, that type of thing. And yeah, I mean that's by far the easiest way to get to me.
Cool.
And I just want to mention, Scott is an invite-only CEO coach. Mm-hmm. So the advice that you're getting, actually, you can get personally. Like, this is really important to know. There's a lot of coaches out there, but someone that's done it is really different. So the type of banter we had here is the stuff that you have to be aware of, what kind of advice you're getting. You just have to be really careful about who you're choosing as a person to help you.
Appreciate you bringing that up. Yeah, it's the program. Yeah. It's a private community for founders. It's called Highland. You can find it on my website too, and I talk about it. But we've got about 50 CEOs in there now. We've been really deliberate about who we kind of let in, and just making sure that everyone's at the same stage and sort of having similar problems across all industries. By the way, not just SaaS. But that's been a really fun sort of give back thing for me. Just getting in the trenches again, keep myself sharp.
Love it.
Yeah.
And we'll link to these things on our on the show notes as well. So just look in the description, and you'll see some links to get in touch with Scott and figure out and find out more about what he's doing today. So Scott, this was awesome. Thanks so much for joining us on the podcast. Love to do it again sometime where Peter can share some of his pearls of wisdom with us.
Yeah, I'd love to come back. I'm sure there's more shitty advice to come. And
just for the record, for the record, in case anybody wasn't clear what we were doing, we were taking, just because now I'm like conscious that people are going to be listening to this, be like, why are they just making fun of this guy? So Peter, we took a LinkedIn post where Scott talked about the worst advice that he's ever been given, and we had Peter play the coach. So this was not Peter's advice. Peter was just playing the role of bad consultant.
Everyone just dropped off.
That's right. Forever, you're gonna be known as the bad coach forever now, Peter.
Yeah, perfect.
Well, this is great. Thanks, Scott. Awesome to have you. See you next time on the Founders Journey podcast.